Hi, I'm Max Keiser.
I'm Stacy Herbert.
You know the global insurrection against banker occupation? We've been telling you about it for months now. It's coming to New York! Stacy.
Max Keiser, the first headline reads, Anonymous joins hashtag Occupy Wall Street. Remember, we talked about this a few weeks ago. This is an Adbusters campaign, and they're encouraging up to 20,000 people to occupy Wall Street, flood into Lower Manhattan, occupy the spaces in front of the banks. And now Anonymous have joined.
Right, so they're going to set up tents like they have in the square in Athens or in the square in Tunis or in Cairo. They're going to try to occupy Wall Street. Now, we were just in New York. We visited Wall Street. There's a huge police presence there. It's a highly commercialized site with a lot of outlets for big brand names. Now, this sounds like it would be counter to those commercial interests. How many hours will this tent city be allowed to exist, do you think, Stacy Herbert?
Well, that's a good point because, yes, Wall Street is surrounded by barricades already to keep people out. Now, these protesters are suggesting that people bring barricades in order to keep, themselves in. So they're being kept out by the barricades that are already there.
Well, Anonymous is a very powerful organization, so maybe they'll add some juice. We'll see.
Well, the protests aren't just going to be on Wall Street, though. They're going to be in Paris, London, Italy, and Spain. Now, still, however, this is what Adbuster says. Tahrir succeeded in large part because the people of Egypt made a straightforward ultimatum that Mubarak must go. So they're saying we need a simple ultimatum like this as well. They go on to say, the most exciting candidate that we've heard so far is one that gets at the core of why the American political establishment is currently unworthy of being called a democracy. We demand that Barack Obama ordain a presidential commission tasked with ending the influence money has over our representatives in Washington.
That stinks as a marketing hook.
Well, exactly, because in Tahrir Square, they were demanding the dictator go. The dictator in this situation are the banksters. Yeah,
they need to surround the New York Fed, which is only a few blocks away, and demand the head of the New York Federal Reserve Bank to leave. And they're not going to leave until the head of the New York Federal Reserve Bank leaves. That should be the whole purpose of the occupation, not to sit in front of the stock exchange and have that highfalutin, fakakta run-on sentence about a laundry list of demands. That never works.
Well, okay, so they're demanding Barack Obama ordain a presidential commission. So let's look at this next headline, Max. Obama goes all out for dirty banker deal. New York Attorney General Eric Schneiderman has been removed from his leadership role in negotiating a nationwide foreclosure settlement with the banks. So all 49 states attorney generals are in the pocket of Obama. They're saying, yes, we'll sign on to this agreement whereby the banks collectively will pay $20 billion to end any foreclosure cases against them. And it seems like what Schneiderman is rejecting in terms of this deal is that he's against the fact that it will basically give them immunity from all other securitization lawsuits.
Yeah, well, it makes me cry to witness the President of the United States kowtow to a bunch of bankers on Wall Street like this. I am personally embarrassed and ashamed that Barack Obama would sell out his people in such a shameless manner. It's beyond pathetic.
Yeah, but again, Max, I know you have a thing about the president, but the population itself. Let's see how many people turn out to occupy Wall Street to demand Obama do something, when in fact it's the bankers who are the ones forcing this situation. They're the ones that the New York Fed is partly responsible for forcing Schneiderman off this case.
That's what I'm saying. See, the New York Fed is the enemy, along with the other central banks hooked into the banking lobbyists. The New York Stock Exchange is just a numbnuts, benign place that matches buys and sells. It's not really the nexus of power that it likes to think itself as being, with the big American flag out front. That's a tactic for diversion. The New York Fed is quietly in the shadows, pulling the strings on Obama. Hi, I'm Obama. I do what the bankers tell me. Bing, 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 bing. And I wouldn't be surprised to see his nose before the election start to.
Well, again, I call your attention to the population of America, and I will say that much of the population, we encounter them often online, and they believe the financial crisis was caused by public sector workers or union members and their pension demands. Remember, $50,000 a year sort of employees. So they don't understand the figures and terms, and they'll think that $20 billion might as well be $150 trillion. It seems like a huge amount to them. So Matt Taibbi in this piece goes on to say, to give you an indication of how absurdly small a number even 20 billion is relative to the sums of money the banks made unloading worthless subprime assets on foreigners, pension funds, and other unsuspecting suckers around the world, consider this. In 2008 alone, the state pension fund of Florida all by itself lost more than 3 times that amount, $62 billion, thanks in significant part to investments in these deadly MBS, these mortgage-backed securities.
Right, and the bailouts starting in 2007 have now exceeded $17 trillion. We find out through a Freedom of Information Act that there was a $1.2 trillion gift given to bankers like Jamie Dimon and Goldman Sachs' Lloyd Blankfein just on the cuff, just to keep them sweet. So now $20 billion in that context is virtually the equivalent of a wad of gum stuck to the bottom of your shoe. I mean, by comparison, I'm sure there are pimps in neighborhoods around the world that carry more in their sock.
And, you know, I want to bring this over to more pension fund stories about this, how the pension funds are being blamed for the market crash. Headline reads, Teacher Pension Fund joins California Auditor's risk list. So this is the California State Teachers Retirement System, CalPERS, remember. They reported in March that it had 71% of the assets needed to cover retirement costs for its 852,000 members and family members. The estimated shortfall is $56 billion. But Max, as recently as 2001, they were 98% funded. The article goes on to say, but benefit changes and economic slumps that hurt asset values have reduced that number. So they're down now to 71% covered. So they're blaming it on an economic slump, not financial fraud, not bankster fraud. So people read this in the mainstream media and they say, oh, it's an economic slump. That's why these pensions are underfunded now. And it has nothing to do with any fraudulent selling of mortgage-backed securities to them.
Well, as we've been talking about for many months, if not years, these pension accounts are where bankers go to unload toxic securities. That's been the story for many years. Remember Robert Citrone, who was running the municipality in Orange County, California, when he bought $100 billion worth of toxic securities and blew up that county. And because the pension fund managers and CalPERS, I know from personal experience, the people who run CalPERS are literally almost on the verge of being brain damaged. They're so incapable and incompetent in what they do. They would buy anything, these pension fund managers. CalPERS is one of the worst. I mean, they're like a little, desperate little puppy.
Max, they're my next headline, so let's move on to show you just how bad CalPERS were in particular. This is a flashback to June 1st, 2007. Banks sell toxic waste CDOs to CalPERS Texas Teachers Fund. Now remember, the importance of this story is Barack Obama has now and the New York Fed have forced Eric Schneiderman off this foreclosure settlement case because they don't want anybody to look at these securitizations. They're saying we need to move on. Let's just pay $20 billion and move on. Bear Stearns and Company, the 5th largest U.S. securities firm, is hawking the riskiest portions of collateralized debt obligations to public pension funds. So this is the media, this is Bloomberg News reporting in 2007, calling it toxic waste. They went to CalPERS, they went to the pension fund managers for Texas, for New Mexico, and said, why are you buying this toxic waste? And they were like, woohoo, we're in Vegas, and this woman, Jean Fleischhacker from Bear Stearns, is pitching us on it, and she has a great pitch.
In between martinis. It's just amazing because teachers who willingly take jobs that don't pay as much as a hedge fund manager because they seek purpose in their life. They want to add something to society, unlike a hedge fund manager, which is just raping society. So not only do they underpay the teachers, then in their pension accounts, they let the hedge funds willy-nilly have access to those funds and dump all their losing bets.
Now, remember, Bear Stearns, of course, blew up. That was the beginning of the financial catastrophe in 2007, March 2007. So Bloomberg goes on to say that Jean Fleischhacker was pitching 50 public pension fund managers, and she told them that they could get 20% return on the bottom level of a CDO, the bottom level, the equity tranche that blows up 100% when the CDO blows up. She said it has a very high cash yield to it. I think a lot of people are confused about what this product is and how it works. Well, of course, it turns out everybody was, but she's trying to say that was a positive, that these people are confused and that's why they should buy it.
Right. Inflation's running at 2% at best in an environment of falling stocks and economic duress. And these numbnuts in the audience in Vegas, half sauced on jalapeno pepper martinis, are told that they can get 20% on a riskless almost deal brought to you by their friends down there at the Wall Street banks. And they buy into it. I mean, I don't know what to say about these people. Maybe the teacher shouldn't get any money.
Well, I have something to say here, Max, because Fleischhacker, according to this article, told the public pension managers that a CDO is like a financial institution. Both have strict oversight, she says. The outside agencies that oversee these structures are the rating agencies, comparing them with the Federal Deposit Insurance Corporation and the OCC, which regulates banks. Again, Barack Obama is saying, let's pay $20 billion, shut down all investigations of the securitization fraud. Here we have in 2007 open fraud happening where this woman is telling these pension fund managers that it's risk-free, it's like the FDIC, you can't lose. And they're like whooping it up in Vegas, spending our pension fund money on these collateralized debt obligations that have now blown up, and Barack Obama is trying to say you can't look at them ever.
Well, CDOs are like an institution, a mental institution. Anybody who buys these things clearly is being missold. I mean, it should be a crime. And of course, the rating agencies gave the CDOs AAA ratings because, as we now know, they are completely conflicted. They take money from the banks they're supposed to be rating. So there's a natural conflict of interest there. It's fraud. Moody's, S&P, and Fitch commit fraud. They commit fraud, F-R-A-U-D. Then no one's going to call up and say, hey, Max, don't call us fraudulent peddlers of fraudulent securities, because they'd have to prove that they weren't selling fraudulent securities. And I have yet to got that call yet. Come on the show. It's total fraud. The fact that they even have a license to operate in America shows that America has become one big cluster.
Well, the important thing, Max, is this was in 2007. It's openly reported in Bloomberg News. Barack Obama, Eric Schneiderman, all the attorney generals who are demanding that Eric Schneiderman make a deal with these banks to give them immunity from all of this fraud. They're saying that they want to move on, and $20 billion, which is not even half of what they collected in bonuses, Christmas bonuses last year. And now all across America, you're seeing austerity measures imposed. And a lot of the population demanding it, that it's these pension funds that they're underfunded now. It's the reason why they're underfunded is because they've made too many promises, when in fact too much has been stolen from them. And this is the fact. This is the truth. We've reported on this for years now.
Yeah, I mean, next time I'm in Vegas, I'm going to stop some teacher on the street, punch him in the mouth really hard, steal all their money, and then as I'm walking away, toss them a nickel. It's the same thing. And they'll be like, thank you, thank you. All right, Stacy Herbert, well, thanks so much for being on the Keiser Report.
Thank you, Max.
Don't go away. Much more coming your way, so stay right there. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Shanghai and talk with Daniel Collins. He's the founder and chief investment officer of Tiger Hill Capital Management. He also wrote a recent article titled Rising Chinese Redback Could Overtake Debased Greenback. Could money printing in the U.S. speed the rise of the Chinese currency? Dan Collins, welcome to the Keiser Report.
Hi, Max. Good to be here.
All right, Dan, tell us about the Redback, and is it going to overtake the U.S. dollar, and if so, when?
The article I wrote really talked about, as we've seen continuous money printing, especially in the last few years, the world's really looking for a new store of value. As everybody knows, China is also trying to limit its increasing dollar reserves. And they really have a three-phase strategy to internationalize the renminbi, starting with making it an international trade currency. As anybody's been to Hong Kong recently has seen that The renminbi deposits in Hong Kong this year will rise at roughly 300% to go over 1 billion US dollar. China's also signed currency swap agreements with over 15 countries. This is really the first step of trying to internationalize the renminbi. The trade numbers that have come out this year show that international trade, which was in renminbi last year, was about less than 1%. This year will be roughly 7%. So what China is basically trying to do is turn most of their contracts into renminbi as opposed to dollars.
Okay, let's talk about what happens when China sells some stuff to America. It ends up in Walmart. They use the dollars, however, in China to make sure that these dollars don't inflate the currency back home. They end up printing their own RMB, correct, to sterilize this transaction to some degree. Can you walk us through? Because, in other words, China's printing a lot of RMB as part of that relationship with the U.S. They're the biggest exporter. U.S. is the biggest consumer.
Yep, absolutely. What happens basically is a Chinese factory here or a company will export something to, in your example, Walmart. The company here in China will receive U.S. dollars. Those dollars then go back to a bank in China and are converted back into renminbi. China then takes the U.S. dollars and in the past few years, in the past decade really, has been buying U.S. treasuries with it. And that's really, and as you're exactly right, China has to print renminbi to soak up those dollars. And that's what's really led to the high inflation here in China. Official inflation rates in China are 5 to 6%. But most people here would tell you they're closer to 10%. So a rising renminbi is going to help the inflation problem in China. And I think the central bank here in China finally is coming to that conclusion as well.
Okay, well, one of the biggest problems with the U.S. dollar, of course, is that the U.S., instead of dealing with their banker corruption problem, they're simply printing more dollars in the hopes that by bailing out the creditors during the last 5-year mortgage fraud episode, that somehow the growth engine will start up at some point. And what we're seeing is, of course, the exact opposite. They're just exacerbating the problem. So that's the problem with the U.S. dollar as reserve currency. But now if China is also printing up lots of RMB, this kind of undermines or undercuts the Redback as a reserve currency going forward. Isn't that the case, or how are they addressing that?
Yeah, absolutely. And I think that's why we've seen some recent acceleration in the renminbi increase this year. I think we will continue to see it increase much faster. We won't see any one-time appreciations, but we will see much faster appreciation of the renminbi. Once the currency and these contracts, especially with emerging markets, China's focus is really to get the renminbi internationalized first in the emerging markets. We see some central banks like Malaysia are now holding renminbi. So as the renminbi becomes convertible, China will no longer need these dollars, and therefore they won't need to buy so many treasuries.
Okay, so on the road toward the Redback becoming dominant world reserve currency, first they have to unwind a lot of the dollar-based currency transactions around the world. So you've talked about a couple. They're doing currency swaps with big trading partners like Iran, China, Brazil, correct? So these countries will take on huge RMB, and in exchange, China takes on huge portions of their currency. So when deals come up going forward, they can use some currency other than the U.S. dollar. And additionally, they're allowing the RMB to appreciate. Now, this would give consumers in China greater purchasing power, at the expense, however, of that big export engine. So in the mind of the People's Bank of China, are they making this calculation as to, well, if we let the RMB rise, we're going to cut our exports. However, we are giving greater purchasing power to our own emerging middle class. Are they ready to make that move?
Yeah, I believe they have no other choice. The only other option is to continue to work 12 hours a day in a factory, send the products to the United States and collect back printed dollars with it. So, they may as well ship the containers off and dump them in the ocean. They have now come to that conclusion, and absolutely, the last 20 years, China has exported deflation in consumer goods. The next 10, 20 years, we're going to see massive inflation in consumer goods as the renminbi rises. China needs to raise the living standards here. They know that and increase stronger renminbi is going to do that.
Right. So people who shop at Walmart, again, stocked with a lot of Chinese-made goods, it's a bit of a poison chalice because the people in the U.S. end up cutting their own wage growth and their ability to collectively bargain for increased wages until such time as prices bottom out. Then they start to go up, and now the workers in the U.S. can't even get the cheap goods anymore, and they have no wages. So that'll be a big fun for them to make that discovery someday in the very near future. Now, the Chinese rating agency, Daegong, was the first to downgrade the U.S. debt before S&P famously downgraded U.S. debt. Now, do you see China moving away or moving toward an additional downgrade, staying ahead of the curve? Is this part of the strategy to move to get the world onto the Redback and off the Greenback?
Yeah, the Chinese ratings agency is obviously a lot more honest than even S&P and Moody's. I give S&P credit for stating the obvious, that the world's largest debtor has a AAA credit rating. It makes absolutely no sense. On the other hand, China's credit is rated far, far below that of the United States, yet they're the world's largest creditor nation. So these ratings agencies, just like the subprime mortgage issue, they have to get more realistic and start rating things correctly. I don't think China's using their rating agencies, Daegong, as a policy tool. I think they're just rating on what they, based on the numbers, basically.
We have a guest often, Jim Rickards, who's coming out with a book, Currency Wars, in the very near future. The title says it all. The countries are fighting a war using currency. And we know that relations between China and the U.S. are beginning to get a bit strained. That China is upping their military presence. They're upping their stealth jet fighter technology, etc. So currency wars would seem perfectly in keeping with the idea that the Daegong rating agency would politicize that decision somewhat, because the World War III we're all engaged with now is a currency war. So is there this type of talk inside China? You're in Shanghai. Do people see this as an emerging currency war? Do they use this type of language at all? You're right there in Shanghai. Is this what's going on?
I don't see many people talking of currency wars. Actually, it's becoming more of a political issue here to keep the renminbi low and to keep shipping goods to the United States and have them print them. That's what's finally catching people's notice here is, why are we working 12 hours a day in the factories and shipping products over the United States and just have them print money? So obviously the U.S. the Western world is in a position financially where they have no choice but to keep printing. Obviously they do have a choice, but it would require more fortitude than our politicians seem to show at this point. So I personally expect a lot more printing of dollars. And we see that going on in Japan and Europe and the United States. The countries that stay out of the currency war mostly focus on precious metals, and productive capacity and engineering and education are going to end up on top.
I just saw a report on TV recently talking about in China, approximately 100 million consumers have credit cards of a population that's, last I checked, 1.2, 1.3 billion. So credit cards are almost non-existent in China compared to a country like the U.S. or Britain or Western Europe. Is this something that the Chinese population is going to readily take to? Because you need the middle class to start using credit cards quite aggressively if you're going to build that consumer-led model based on a rising RMB. And also talk a little bit, if you can, about the fact that, correct me if I'm wrong, but in the U.S., you have most of the millions of homes are in negative equity. People don't own any equity in their homes. Whereas in China, virtually all the homes that are owned are 100% owned. There's very little debt attached to those homes. Again, a source of buying power if leveraged. So how does leverage factor into this? Are the Chinese ready to shop until they drop?
The Chinese consumer, I believe it's kind of a misconception that China is not a consumer. China this year will purchase 22 million vehicles. Compare that to the United States, it'll be roughly 11 or 12 million vehicles. China is the world's largest luxury goods market. So there's a massive consumerism going on here, especially in the Tier 1 cities. With regard to credit cards, they are becoming a lot more popular. If you see The major cities, most transactions now occur through credit cards, and those will continue to roll out in the Tier 2 and Tier 3 cities. In the United States, we also have a misconception that China's more heavily dependent on exports than they are. In reality, the major market here is domestic, and more exporters are focusing more here on the local domestic market, and will start to walk away from the export market. In fact, in many product lines here, you can get a higher price selling in China than you can now get exporting.
All right, Dan Collins, we've run out of time. Thanks so much for being on the Keiser Report.
Thanks, Max.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Dan Collins. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.